All right, so part 2 of 2019 year-end tax planning. I had forgot to log into my screen share program, so it cut me off after a 15-minute hard stop. So sorry about that. All right. So what we did is we added Social Security, all right, to our $1 million that we had in Wellesley Income Fund, which means that we don't need to take money from Wellesley Income Fund. But Wellesley Income Fund still has significant taxable interest because it does have high interest in dividends, high interest in bonds as well. So we have pretty significant taxable interest. But now what we're going to do is we're going to add a 5% portfolio turnover as we'll just a typical index fund. So basically we're still saying it's a Wellesley Income Fund, but we're going to add a 5% portfolio turnover. And let's see what this looks like now. So the issue is that we had about $10,000 in taxes last time. Let's see where we're looking at today. So let's take a look here. Still, the tax is pretty high. It's going up to 12, 13, whatnot. But let's take a look at the 1090 or 1040, shall we? So here, first year, we don't have much in terms of taxable income because we haven't kicked into Social Security yet. So we're going to go to 2030 and watch this. Now our taxable income is $18,000. So, I mean, now our taxes are $18,000 simply because we have long-term capital gains that are going into our taxes. So what is happening now is we have $102,000 of Social Security, which is what we had before. But before we had about $60,000 of taxable Social Security. Now we got 33% more than that. We get $82,000 of taxable Social Security. And the reason for that is because of the 5% turnover in the portfolio, i.e. is generating capital gains. So we still have a bunch of taxable interest, $38,000. We still have a good amount of dividends, the vast majority, 80 or 90% of which are qualified, which is good. But because we're now no longer in the 12% tax bracket, these are taxable at 15%. Again, because this is Trump tax bill is gone. These are taxable at 15%, and the rest is taxable as ordinary income. So our taxable amount of Social Security has gone up. So now we have an AGI of $162,000. We take out our standard deduction. We take out our personal exemptions. Taxable income of $132,000, which puts us well into the 25% tax bracket. All right, but now where's the taxable income come from? Because we are showing here $81,000 of Social Security plus $40,000 of taxable interest. That's $120,000 plus $15,000 of ordinary dividends. So where's the rest of the money come from? Well, it's going to come from Schedule D because we have a 5% turnover. So we have $2,800 of short-term capital gains, which is taxed as ordinary income, and $25,000 of long-term capital gains, which is taxed as 15%. And so because of that, what's happening here is that is flowing. Well, let's just go back to Schedule A, 1040. That is flowing back to the 1040, but you can't see it here. Now, next year you will. Next year there will be something for capital gain income on the front page of 1040. Next year being 2020. This year there is not. But either way, that 5% turnover has generated an extra $8,000 of taxes for us. So let's just go back. We can see $18,699. So if we go back to profile and we go back to expenses, and we go down to fees and we say no turnover, there's no turnover. Remember, $18,699. Everything else is still the same. Everything else is still the same. And we're going to go to tax. We're going to go to 220, to details, 220. There, 230. There we go. Look at that. Everything else is still the same. Now here, $102,000 of Social Security, but only $60,000 is subject to taxation. We had 5% turnover. So now 20,000 more of our Social Security is subject to taxation. We're in a 25% tax bracket. That inherently means that's what $5,000 of income tax more we're going to pay. Plus the fact that 5% portfolio turnover is also subject to taxation too from capital gains. So that's a big deal. Now, even if some of it's, the majority of it's taxed at 15%, not ordinary income, but that's another $3,000. So just say you have $20,000 of capital, long-term capital gain times 0.15. Yeah, that's $3,000. So there you go. Those are $8,000. $20,000 more is tax of Social Security is taxed at 25%. A $20,000 long-term capital gain is taxed at 15%. That's another $3,000 plus the $5,000 extra Social Security tax you got to pay, and there's your $8,000. So again, that 5% portfolio turnover increased our taxes by 80%. It's nuts. That's why I get to look at your 1040. And you got to look not just the front page, but you got to look at schedules 1 through 4. And right here, you see Schedule 1. It doesn't say anything. You're like, oh, it doesn't say anything. I don't think I have anything. No, you got to look at Schedule D right there. Schedule D. You're like, oh, well, it's not saying anything because we didn't have any. There we go. Go back. It won't say anything in this case because we didn't have any capital gains. But we got to go back to put capital gains on there. There we go. And we're going to get 5% turnover. Boink. All right. So now we go back to schedules 1 through 4 in Schedule D. And we're going to hit details, go to 2030. All right, so Schedule 1 through 4, this will be where it shows you the total capital gains, 28,147. And where's that coming from? It's going to say what's of that 28,147. 2,800 is from short-term capital gain. 3,032 is from long-term capital gain. You go to Schedule B for the taxable interest. And here you got $38,000 of interest, $38,000 of taxable interest. And ordinary dividends, another $14,000 bucks. So that's a lot of taxes that you got to keep aware of. And you got to just follow these things. You can't just look at the front page of the 1040. Don't do that. All right. Hope this helps. More to come. We'll see you next time.